Hi everybody, it's Bob Icino from the Pure Exposure Growth Series and Path Trading Partners. I wanted to make a quick midday video for you guys. Now again, you're not going to see this midday obviously, but it is 11 o'clock Eastern time, 10 o'clock Central time, and I'm looking at a stock market that's up between 1.35% and about 1.86% the Dow, with the S&P in the middle. The NASDAQ is the one that's trailing right now, and risk assets are up as well. Crude is up, copper is up. And that's the reverse of yesterday when the Fed cut rates 50 basis points, what they're calling a mid-meeting cut. But I don't know how you call it a mid-meeting cut when the Fed meeting is actually next week. It's not quite mid-meeting. But it certainly was not a surprise in terms of the cut itself. The CME Fed Watch tool had the cut at about 100% probability for the meeting that's next week. So the cut itself was not really a surprise. It was actually basically announced on Friday. The timing of the cut was strange in that there was really no reason, in my opinion, to do it early. Now, my job is not to say whether policy is right or wrong. My job is to say what the effect of it was or is going to be. And the markets took it pretty hard. They initially popped, and then they fell pretty dramatically, really on the impression that the Fed knows something we don't know. And I want to touch on that in a minute. But the Fed seemed to rush to it. Now, it might have had something to do with the G7 call that happened just before their announcement. So the finance ministers and Treasury Secretary Steve Mnuchin, along with the central banks of the group of 7 countries, the G7 countries, it's the largest developed economies, the largest 7 developed, excluding China, got together on a phone call and kind of discussed how they were going to deal with the inevitable economic slowdown from the coronavirus. And one of the things they may have discussed was that the U.S. Central Bank needs to lead. Now, the day before that, we saw a cut from the Royal Bank of Australia. Now we're going to see a cut from the Bank of Canada, U.S. in between that, and then we've got more central banks coming up who are likely to take the same action and have this sort of concerted central bank action to kind of prop up the economy. Number 2, we've got non-farm payrolls on Friday, the biggest economic piece of data that happens every single month. And the private payrolls number came out and actually beat expectations. But I'm going to put a little conspiracy theory out there. And I'm not a conspiracy theory person because I really don't care. I react to what price action does, which I'll talk about in a minute as well. But I'm going to put out a theory that maybe the Fed got a glimpse at a bad unemployment number that's coming out this Friday. We'll see. But that might be a reason to do it before that unemployment number, because people basically say, look, inflation is backing off. Remember, inflation has been above on a year-over-year basis that 2% level lately. Wages have been growing, so they're expecting them to fall by 1/10 in this particular number. Maybe wages fell. Maybe the hourly work week was lower. Maybe the number of jobs that was added on is going to be less than expected, which right now it's about 175. So the Fed may have gotten a glimpse of that. We don't know. So it's either G7 pressure, which Jerome Powell would have had to agree to, or there's a bad non-farm payrolls number, or they just think it's going to be good to have this insurance policy. The problem with this rate cut, it's very difficult to take these rate cuts back without getting an effect on the market. So again, rate cut happened, markets fell, they're bouncing back today. Now, I want to go into, let's use a Dow chart. Let's use a Dow chart. I'm going to pull up a Dow chart, but it's going to be the same in every single one. And I want to show you kind of what I mean by, or what I meant by in the last video when I gave us a little pat on the back for saying we would buy on Monday, up 1,200 points in the Dow on Monday. And we said we would buy Monday morning. But then in that video, I said, well, the worst is not over yet. And I'm going to show you why in this chart. Okay, so here we've got the March E-mini Dow contract. And part of the reason I'm looking at the futures to give you this example is because when you have volatility like this, people get nervous about risk, and they should. They really should. So I'm going to focus on kind of the micro contract. But I'm looking at the Dow. They move the exact same, so the chart's going to look the exact same. So this is the Dow futures, the March contract, as you can see right here. Right, E-mini Dow March. You can also use equity options to do this. You can go to one of the index options on your E-Trade platform. But this is a futures contract because, again, if I did this, I would probably do it in the micros to reduce risk in a high volatility environment. But anyway, this is a live chart. It's a screenshot of a live chart. So here I've got the most recent price action, obviously in that circle right there. So what I want to look at is in the midst of this down move, right? I got a cross in my key exponential moving averages. Now, I don't trade the cross. I personally don't care about this down move. It's not my trade. It has nothing to do with me. So what we're trying to do is look to see if the downside is over yet. Now, that doesn't mean that I've got to go long. It could mean, of course, again, I've got the micro Dows here in the mini Dow. So depending on what your risk tolerance is, you could use one or the other. But I can go short this. And what I meant in my last video when I said I don't think the worst is over, it's because of this setup right here in the recent price action. So I've got my key exponential moving averages, one in blue, which is longer term, and one is in red, which is shorter term. And they're on a sharp downward angle and they're widening out. Okay, so what tends to happen, doesn't have to happen, but what tends to happen is price will trade up into this area that we call a rotation zone, possibly even getting to that 50 exponential moving average, which is in the blue line right here. That's the 50 that everybody looks at, right? So it might get up into there, and then when it does, or if it does, I'm going to draw what we call a best fit trend line right there. Once I draw that trend line, if the market then reverses and gets below that trend line, I can then take a short position. Now, I don't want anyone to just take a short position if this particular setup happens, because there's more to it than just that. You've got to have risk parameters, stops, position size, targets. The risk reward ratio has to be right, but that would be an entry trigger for me. So all I'm looking for is if this move is going to extend, I want to get a portion of that extension. I don't care about this move. I'm looking for the secondary move, right? Because that's going to be a more high probability move to trade. Conversely, if it gets up above the 50 and gets up above this sort of baseline area here, it could mean a reversal and a move even higher. I won't necessarily trade that either, but it kind of takes away the potential rotation zone trade down that I'm talking about. So this is what I meant when I said the worst is not necessarily over yet. All right, so that's a quick example of how we would enter a position theoretically. Now, there's a lot more to it. So I'm not telling anyone to copy this and enter a trade. Make sure you don't do that, because there's risk metrics, there's targets, there's position sizes, all kinds of things that go into this. But this shows you how we kind of use moving averages to enter into trades. So it's just a little bit of a peek behind the curtain there. And that's why I don't think the worst is over yet. There's some upside that has to be corrected. The next thing that I wanted to talk about going forward anyway was the economic effect and the predictability of it. I don't think there's any. And that's why I think the Fed was a little early on doing this rate cut, because they took two big bullets out of their holster. Now the market's going to expect at least another 25 basis points. We're seeing yields back up. We saw 10-year yields go below 1%. And we're going to need to see fiscal policy. And because we're in an election year, that fiscal policy in the US becomes a lot harder, because the Democrats who control the House of Representatives are not going to want to give any significant win to Donald Trump unless they're able to take all or most of the credit for it. So I hate that it's like that, because you'd really like to see the government helping the people in a time like this. But this is a very big election for both sides, and they're probably not going to do that. And lastly, I want to talk about the results of Super Tuesday, because what we're seeing right now is a big bump in healthcare stocks. And that's part of the reason that the Dow is outperforming the NASDAQ and the S&P is outperforming the NASDAQ, because of the concerted healthcare stock representation in those two indices. And that's because Joe Biden just killed Super Tuesday and narrowed that delegate gap. And now you've got Michael Bloomberg, who left the election, now backs Biden. Amy Klobuchar backs Biden. Pete Buttigieg backs Biden. So Mayor Pete is likely to deliver Indiana for Joe Biden. So that's more delegates there. And he won Texas, mainly because of Beto O'Rourke. He also won Massachusetts, which is kind of embarrassing for Elizabeth Warren because she's from there. But Bloomberg and Warren had said they were going to stay until the convention. Bloomberg is now out, and he's backing Biden. So Bloomberg's money is going to go to Biden as well. So it looks like it's leaning much toward Biden. Biden's got the momentum. That's good for healthcare stocks. That's the only reason I care about this. So you've got Bernie Sanders starting to be on the decline, and you're seeing healthcare stocks pop because of that. So again, we'll look at it from a price action basis, but it is now, at least in the short term, safe to get back in the healthcare sector. Thanks for watching. Don't forget our next live trading event, the Pure Exposure Growth Series, is March 16th. Sign up below. I'm looking forward to seeing you all there, and I'll see you in the next video.